Hey guys, today we're going to be talking about the Tesla stock, the company that's been dominating the global headlines, the company that made Elon Musk the richest man in the world, the company that's worth more than Toyota, Ford, GM, Nissan, and Daimler-Benz combined. The company that owns more than 50% of the world's global automobile industry market share. The company that... Yo, Eric. What? Eric. Yeah, what? Tesla doesn't own 50% of the market share. What are you talking about? Yeah, they're not even close to 50%. Stop spreading false information, dude. Yeah? Then how much do they sell then? Dude, they only produced like 500,000 cars in the year 2020. Yo, what are you trying to say here? Yeah, dude. The global production for the cars in the year 2020 is about 80 million. So for Tesla that only produces 500,000 cars in 2020, that's less than 1% of the global production. Wait, what? Then why the f*** is the stock price so f***ing expensive? Now, before we begin, please remember to subscribe and smash the like button for the YouTube algorithm. And also, please be sure to stick until the end of the video for a special announcement. And with that, let's talk about the Tesla stock. Yes, the stock is all over the news recently, and there's a huge debate among investors about whether the stock is undervalued, overvalued, or priced just about right. Well, the truth is, the correct answer is very subjective, and different people might have different opinions. And if you want to form your own opinion, there's several ways to do this. Now, the first way is to grab Tesla's balance sheet and study the balance sheet for a couple hours and scrutinize each line of data. And if you're new to investing, maybe another couple months on an accounting course just to understand the balance sheet. Well, if you're like most people, ain't nobody got time for that. So let me give you a simplified method. You want to look at the PE ratio. The PE ratio usually gives you a pretty good indicator on whether a stock is overpriced or underpriced. Yo, Eric, what's the PE ratio? Tell them what the PE ratio is. Ah, good question. The PE ratio is the price to earnings ratio. What does that mean, you might ask? Basically, the PE ratio is a ratio that calculates the company's share price relative to its earnings per share. To give you a very simple example, if the company earns $100 and the company issues 100 shares out in the open, the EPS or the earnings per share will be $1. Now, if each stock for this company is worth $20, the PE ratio will be 20. Simple enough? Many investors will actually use the PE ratio to determine if the stock price of a company is overvalued or undervalued. Basically, the PE ratio is the number that the investors and the market is willing to pay per dollar of profit generated by the company. Now, the average PE ratio for the S&P 500 is about 15. So for the average S&P 500 company, an average investor is willing to pay about $15 per $1 of profit generated per year for the company. Now, every company is different. Some companies can have very high PE ratios, some companies can have very low PE ratios, depending on how the investor sees the outlook of these companies' profitabilities for the future. So, for a company like Amazon, which has a PE ratio of about 90, which is significantly greater than the average PE ratio of an S&P 500 company. That means that the average investor sees a higher growth potential in Amazon than your average S&P 500 company. However, if you see a company like Xerox, their PE ratio is about 5.5, which is significantly less than the S&P 500 average. We can see that the average investor sees less growth potential in the future for a company like Xerox, and thus paying less per dollar of profit. Now, to give you an example, let's use this lemonade business example. Melanie earns $1,000 a year in profit on her lemonade stand. Dan comes along and offers to buy her business. If the operations stay the same, do you think that Dan will pay $90,000 for a business? Probably not. Dan literally has to wait 90 years just to break even. However, if Melanie's lemonades have some special formula, you know, putting in secret stashes of marijuana, nobody has to know, and Dan sees the potential in her business, maybe paying $90,000 for the business isn't such a bad idea after all. Look, I'm just joking, guys. Please don't take this seriously. Don't actually go out and do something illegal just to make money. But my point is, if investors sees potential in the company growing, they will pay more to invest. Now, let's get back to Tesla. Alright, I mean, Amazon's already at 90 PE ratio. How high can Tesla be? Try 1600. Wait, what? You mean to tell me that investors are willing to pay $1,600 per dollar of profit by Tesla? Wait, that doesn't make any sense. Yeah, you know what? It has to be overpriced. There's no way. Well, you know what? It's really not that simple. Because sometimes, well, many times, the PE ratio can be pretty misleading. So for many of these high growth potential companies, they're actually spending a lot of money in the beginning on infrastructure. So, you know, manufacturing facilities, warehousing, technology. And when they do have these invested in, they have their foundation laid out, future production becomes much cheaper and much more efficient. And you know, the initial investments on the infrastructure can cost a lot. So for the first few years when the company is rapidly growing, the company won't be making much of a profit because they're spending so much money on infrastructure and building a foundation. Now, I did find an amazing Reddit post by a guy by the name of Connor84, and the companies like Amazon had a PE ratio of about 3,732 back in 2012. Now, let's be real here. The Amazon of 2012 is definitely not the same as the Amazon of 2021. It was a time when they spent a lot of money on trying to improve their infrastructure so that a couple years down the line, they're able to dominate the market like we see them do right now. And because of the cost required to improve the infrastructure, Amazon's PE ratio back in 2012 was really high. So back to Tesla. If Elon Musk is able to do things right, which I think he will, never bet against Elon Musk. If Tesla is able to increase market share and increase the margin of each unit sold, I can see their profits shooting way up. However, there's still another factor into play here. How well will the electric vehicle market do in the future? Currently, only about 2% of the global car sales are electric, and less than 20% of that are Teslas. However, if the world is indeed going greener, which I believe it will be, and if Tesla is able to increase their market share to about 25 to 30% of the total amount of electrical vehicles sold, I can actually see their profits shooting up by a multiple of 10 by the year 2030. However, even at that profit rate, with the current stock price, the PE ratio will still be about 150. So if you want my honest opinion, I do think that the Tesla stock right now is a little bit overpriced. However, I've been wrong too many times in the past. Just to let you know something kind of embarrassing, I actually thought that the Tesla stock was overpriced back in December when it was $600, and I sold all of my shares. I mean, I did make a profit, I felt really good, I felt like a boss, but boy, do I look stupid now. Honestly, I wouldn't even be surprised if the stock of Tesla shoots up to over $5,000 by the year 2025, which would make Elon Musk the first trillionaire we ever had. Or the idea of electric vehicles completely flops and the stock of Tesla goes so low. I can't believe I literally just did that. Yeah, you know, I'm still addicted to K-pop. I mean, if you're interested in my previous video on how to invest in K-pop, please click here. But to be honest, I mean, nobody can accurately predict the stock market. I mean, that's how the stock market behaves, right? Anyways guys, thank you so much for watching my video about what I think about the current stock price of Tesla. Hopefully, you learned the concept of a PE ratio, which can be used to determine the value of a stock. And if you're still watching this video, thank you so much. I'm planning on a giveaway. Once we reach 50 subs, yes, just 50 subs. We're not that far away, we have 41 subs right now. One lucky subscriber that comments on this video down below will be automatically entered into a draw for a $25 gift card from Amazon. And the winner will be announced by the end of the month. And with that, please remember to subscribe and hit the like button for the YouTube algorithm for more content regarding financial planning, financial investing, job search, and occasional financial comedy, just like my last video, you know, like this one, how to invest in K-pop. Thank you so much, and I'll see you next time.